Welcome to Annuity News Now. A recent article in Forbes.com highlights a new concept that has developed in today's low interest rate environment. The concept is negative real interest rates. Here to discuss what this means is Chris Price. He is Director of Broker-Dealer Relations with Shurwest Financial Group. Chris, always a pleasure. Welcome back.
Thanks for having me, Scott.
So let's begin with what exactly negative real interest rates are.
Well, negative real interest rates are when the CPI, or the Consumer Price Index, is greater than current interest rates. The CPI is one of the most frequently used statistics for identifying periods of inflation or deflation.
Can you give us some kind of example?
Oh, sure. A negative real interest rate is a rate below zero, where the lender actually pays interest to the borrower. Example of that is the federal funds rate is lower than the rate of inflation, resulting in a real interest rate that is technically negative. In the United States right now, we currently have a negative interest rate, or negative real interest rate, of about 3.25%.
Can you give us a simple explanation of inflation?
Oh, absolutely. As inflation rises, every dollar we have will buy a smaller percentage of a good. An example of that is if, say, the inflation rate is 2%, then a $1 pack of gum will actually cost $1.02. It essentially weakens the dollar's purchasing power.
So let's talk about how negative real interest rates would affect your investments.
Relating this back to your last question about inflation. Inflation is a bond's worst enemy. Inflation erodes the purchasing power of bonds, CDs, and money markets' future cash flows. So in turn, what happens is clients are actually losing money due to the inflation. That's why you really need to assess your goals and look at other fixed income vehicles such as annuities to help keep them ahead of that.
Finally, let's talk about how an annuity strategy replaces these traditional fixed income assets that may be causing some people to lose money.
Well, nowadays, there's a lot of annuities, or many annuities are offered with income riders. And these income riders can replace the lower yielding CDs, bonds, and money market accounts that were prevalent to producing income in the past when interest rates were higher and inflation was lower. So again, depending on the annuity being utilized, some of these riders will pay a client anywhere from 6, 7, maybe as much as 8% growth in an income base. So thus, making up for any income deficiencies that their traditional fixed income assets are paying, or in this case, not paying.
All right, Chris, great stuff. Thank you for being here.
Thanks for having me, Scott.
That is Chris Price. He is Director of Broker-Dealer Relations with Shurwest Financial Group. I'm Scott Drake. You're watching Annuity News Now.